afternoon. My name is Stacey Ziarko, and I'm the president and CEO of the Sterling Heights Regional Chamber of Commerce. We are here today with Luke Bonner, the Senior Economic Development Advisor for the City of Sterling Heights, Steve Couchman from Live Picture, our technology guru and extraordinaire, and Bradford Vannelli from UBS Financial. So good afternoon, and thank you all for being here today with us. Bradford, we are here today to talk a little. We've been sharing information for our members and our residents about how COVID-19 has impacted all of us in a lot of different ways. And so we'd like you to talk a little bit about the financial markets, how this has affected those, and what we might be able to expect.
Sure. Well, good morning, and thank you for the time. Glad to be here. So we have seen unprecedented volatility and market decline over the last 4 weeks or so. This year started off quite well, as we all been experiencing lovely gains in the markets for the last almost 10 years now. Unprecedented bull run that unfortunately came to an end here just this last March. From the top of the market at the end of February through yesterday, I should say, the markets have declined anywhere in both the United States and globally, anywhere between 20 and 35%. So I'll call it a third of assets basically evaporated in a very, very short period of time. This has been compared very much so to the massive declines that we're seeing not only during the financial crisis, which most people remember 11 years ago, 08 and 09, but in some cases the severity of the decline was equal or on par to the Great Depression, which a lot of people may not remember, but it's certainly a significant thing in financial times. And I'll tell you the thing that, from my professional opinion, being 20 years in the business, what has been most shocking is not necessarily the decline, or I should say the percentage decline of asset depreciation, but the speed with which it happened. It was basically 20 trading days where we lost 27%. That is an all-time record. The entire month of March, every day in my world, we were breaking records, unfortunately on the downside. The average daily movement of the market in the month of March was over 5%. That has never happened in history. Typical monthly or daily movement of the market these days would be 1% or less. We averaged 5% in both directions. So that being said, there was literally nowhere to hide in the financial markets. You had a situation which is kind of unprecedented at the time, where you had stock prices declining, you had bond prices declining, interest rate fluctuation, oil declining, gold declining. There was basically nowhere to hide. There was a massive run for the exits, as we say in my world, where people said cash is king, and they sold everything. And there was a lot of emotional selling that started happening by the second, third week of March. I believe that we have started a bottoming process. Our research department and a lot of my peers on the street, not only for UBS home office, but my competitors as well, Morgan Stanley, Goldman Sachs, et cetera. We're looking right now with where we are in the markets, the Dow being kind of stabilized, if you will. The Dow went down to 18,000 from 29,000. Now we're back above 21,000 again in a very short period of time. We think that we've started a bottoming process, but I will tell you that historically, what markets need is information. Stocks, as we all know, trade on future values of companies' cash flows. Well, we have a situation right now, in our opinion, that's unprecedented. We have no idea what the future cash flows are going to be. If we are not already in a recession, we're going to be going into one. That is our base case. We've never before had a situation where the United States has basically shut its doors. Between not only state mandated shutdowns, but the national level, social distancing, slowing down, et cetera. We've never been in a situation where businesses were, quote unquote, forced to close. That obviously brings revenue, not just declining revenue, but it brings revenue to zero. And that has already started to make significant effects on the overall economic activity of this country. Last Friday, we had another record job report. Obviously 10 million people now currently applying for unemployment benefits. That number is likely to rise precipitously, could in some cases reach unemployment rates of 10 to 15% by some estimates in the next quarter or so. But let me say back up for 1 second and kind of give you some positive shoots out of all this thing, because there's a lot of negative news, obviously. For one, we're having an excellent day today. Markets are up over 4.5% right now currently, and continuing to go up, which is a good thing. So I think the market is trying to find a bottom, but I will tell you that we think in most cases, if we can get this country back open, not only to the state of Michigan, but the rest of the country as well, call it early May, end of May for sure, that we can have a somewhat V-shaped recovery. The second quarter we know is going to be gross. It's going to get worse before it gets better. I think you're going to see more negative headlines. You're going to see, unfortunately, more confirmed cases, unfortunately, more death. None of this is good. Nobody wants to see any of that, but we think that the recovery could be pretty quick and pretty violent on the way back up. So what we've been telling clients to do, obviously, is for the most part to maintain your asset allocation. Obviously, most clients we're hoping have advisors. I know I've been telling my entire book of business to make sure that you're allocated properly. You have enough cash reserves to kind of cover your expenses for, in this case, up to 12 to 18 months, to make sure you're not forced to be selling something at the wrong time. Because if you miss these snapbacks, you'll have permanent impairment of capital. In other words, you will not get that money back, because as quickly as the market declines, these snapbacks are also violent as well. And the idea is to stay invested over time. This is not the first, nor will be the last time where we've had a massive dislocation in the markets and a bear market. But if you think about where the markets are already today, even after the decline of March, we're already back up almost 15% off the bottom. We're still down 20, but we're up almost 15% from the bottom just in a very short period of time. So my biggest thing as of late is to try to keep people remaining calm, not making emotional decisions, and know that if you're investing in high quality things over time, that the markets will recover. They always have, and they always will. I believe that America is going to keep running. We just have to get this thing back up and running. It's going to take some more time.
Bradford, can you explain why snapbacks are so volatile and what's the danger in that?
Sure. So snapbacks are typically very volatile on the way up because information is moving faster now than it ever has in my career, for example. I mean, 20 years ago, we didn't have a phone in front of you where you could get real-time data. Now everyone has information 24/7. We have a 24/7 news cycle. And the markets, because there's a lot of institutional and program trading, computer trading that wasn't done 15, 20 years ago, there's huge pools of money, billions and billions of dollars that are programmed by a computer to buy and or sell given a certain indicators of big economic data. So for example, there could be a program out there that says, okay, hey, there's a decline in new cases in XYZ state. All right, that means we have to allocate more money into equities. Just by that program shifting, there's so much money moving, it puts upward pressure on stocks. And stocks tend to snap back violently. And you see when the snapbacks happen, they're typically a couple days in a row. And although this kind of whole March period has been a little bit unique because we had obviously a massive amount of down days, but the up days that we did have in March were up significant. Not unlike today. I mean, right now I'm looking at my real time and we're up 1,180 points right now on the Dow, and we're halfway through the trading day. So these individual days and these snapbacks are important. Then this is why we encourage people to maintain their investment strategy, because you've got to get these snapbacks or you miss the full recovery of the market.
So before the pandemic took over, people were saying for months that if we're not heading into, or if we're not in a recession right now, we might be heading into one.
Yep.
So if you look back on that talk,
Mm-hmm.
How inaccurate or accurate was people's mindsets that, oh, we may already be in a recession?
I would say from a big picture, we expected a recession, but we didn't expect a recession for another 12 to 18 months, because I will tell you that if you look at the data, which is all we can go on, right? The data of earnings growth, interest rates being low, productivity, wage growth, all the data from January and February, the tariff talks had been going well. There was a lot of positive things from an economic perspective, taking away the pandemic, obviously, that allowed us to believe that, yes, markets were expensive. Let's be honest here. At 29,000, markets were not cheap anymore. We had an 11-year run. We were up 350%. But we didn't see an initial near-term, recession. This, I think, is the straw that broke the camel's back, because you had this violent dislocation of asset prices and a huge decline. But it's not the decline in the stock market that's going to put us into a recession. It's the massive unemployment that's going to put us into a recession, and the massive decline in, I will say, economic activity and sales. So I don't know that we were wrong or that the world was wrong in thinking that, I don't think we were in a recession at all in January. And by the way, these recessions, unfortunately, what determines a recession is determined by a committee looking at data going backwards. And unfortunately, most recessions are not actually called for about a year after we're already in one. So for me to say that we're probably in one already may not be necessarily inaccurate, but we won't actually have that official we're in a recession for probably months to come. But it's just obvious to think about the fact that we're going to have massive economic loss of activity and people losing their jobs and businesses, somewhat not recovering at all, if ever. That is going to cause the world to slow down, and we're certainly going to have a recession because of that.
So after the virus sort of flattens out and there's a comfort that people can begin a normal way of life whenever that ends up happening. I'll talk about market versus unemployment.
Yep.
I'm assuming there's going to be a surge in the market after that.
Yes.
But how long do you think it will take for unemployment to decline based on how rapidly it increased, knowing there's going to be a surge in the market, people are going to be productive again? How long do you think it'll take that unemployment to come back down into a reasonable level?
So we have read and published some things where I've been reading that let me back up for a second. The one key factor to determining that how long is it going to take is how long are we going to be on lockdown. So I've read some numbers here that if we are on lockdown through May, so call it the balance of this month, April, the economic activity can get back to within 93% of the pre-pandemic levels by the year end. If we go into June, that number drops from 93% to 80. We go past June, all bets are off. So we don't expect the lockdown to last till July. We're actually calling for a base case to probably be back up and running at least partially by May. And the sooner we get back up and running, the quicker the snapback in employment will be, because remember that the bulk of these folks that have initially applied for unemployment are going to be the service related and end user, end consumer type businesses, mom and pop stores, restaurants, et cetera, et cetera. Those people will be able to come right back into work, assuming that they still want their job, obviously, as soon as this thing passes. The key is the time. The longer we sit on the sidelines, the longer it's going to take to come back. But we expect it to come back. We really do. With the exception of, unfortunately, there's going to be some victims in this because, as you know, those type of businesses that I'm talking to aren't necessarily, have huge reserves. In other words, there's a lot of mom and pop restaurant owners, maybe one or two locations as an example. They've got 30 days of cash. They don't have 90 days of cash. And you shut the doors on them for 60 or 90 days, and they may not be able to come back, nor will they make the decision to come back. That's the bigger issue. So it's all about time. And unfortunately, I don't think any of us know. I mean, you've got you turn on the TV every day and you get two different opinions, right? One side saying, oh, we're going to go back in 2 weeks. One side said, nope, 6 weeks. I don't think any of us know, but I think to your point, we need to start seeing a flattening. And I'm hoping that we're getting some of that. There was a little bit of green data coming out of New York today. And that's obviously, one of the hubs, so as is Detroit from a breakout perspective. But I also think too, there's a lot of things, and this is just me speaking my opinion, there's a lot of things that haven't been talked about this thing either, because the testing is not there, right? There's 40,000 people in Michigan that have been tested. Okay, 15,000 people tested positive, according to the paper today. My guess is there's probably 600,000 people in the state of Michigan that could potentially have this. They might be asymptomatic. They might never get treatment. We're never going to know. And that's what's going to be interesting, is to see how this thing shakes out ultimately, just from the virus perspective, is how big was this and how many people did it really affect? Because that's the issue, that nobody has this data. No one has the information. I have clients that work in healthcare, and the hospitals are a mess. I mean, there's just people everywhere. There's people passing away. There's people recovering. It's just, there's so much data and it flows so quickly. I just wish we had more information, because if we did, we could obviously exploit that from a financial perspective and try and make better investment decisions and get people getting some of their wealth back. Because some of these folks, obviously, if they panicked and sold, they're not going to get that money back. And if you're at or near retirement, the worst thing you could have done is 2.5 weeks ago, pull the chute because you were scared, which I know it feels good. I get it. But my job as an advisor is to keep you there. And had I kept you there, which I did, you've recovered somewhat since then. And that's the key, is making sure that everyone has a plan. And I think that's what's more important, is people stay informed, but take all of the news with a grain of salt and make sure that your plan is specific to what your needs are.
Great advice. Thank you.
For sure. Thank you. Stacy?
Hey, Luke, I told you Luke was going to have a ton of questions.
No, it's great.
I gave you fair warning.
It's great.
Anything else you want to add?
No, I would just say, you know what, I'm honored to do this with you guys, and I'm happy to pass any information as I can. As you would imagine, my job is very fluid. Every day I get more data, so any follow-up I can do. If you want some research takeaways, I don't know if that's important to you or not, I'm glad to provide that to you, Stacy. I have client-approved pieces that you can they're generic, they're not client-specific, but they're just giving insights, if you will. If that would be helpful, I could pass some stuff to you. But I'm happy to be a resource to whenever I can. So.
Well, we appreciate you doing this. We know that, thank you for getting clearance from UBS to allow you to do this today and provide our members and our team with all this accurate information. This will be posted on our social media sites and also the Chamber website. Steve does a great job of editing them. We all look pretty great when this is all over. And we have your logo and everything like that to put with it.
Wonderful. Thank you, because I don't even know how to do that, so thank you.
Thanks, Bradford.
Thank you, guys. Appreciate it. Have a great day today. Thank you.
Thank you.
Thanks.
Bye-bye.